The common thread is, first of all, there's a strategic option trading style that they believe that they're in. I say believe because strategic option trading is much more than just having a few trades on that are usually short option premium, and then trying to let time work for you. Where option decay benefits you by being short options or by being short out of the money vertical spreads or similar type spreads, where time decay works in your behalf. So just because you do that on a few trades regularly, it doesn't mean that you fit into the category of a style of being a strategic option trader. It really is much bigger than that, and having a lot of positions on at one time and managing that. A lot of positions meaning 20 or 30 or 40 or more. The people that write me, they've learned from similar sources about trading options and how to manage the positions. They learn about being mechanical, yet at the same time they're taught that they have to actually trade the position while being mechanical, which has a big contradiction to it just in that. They roll positions because they want to get duration. In other words, longer period of time when some things don't work well, and that's basically the strategy. That if something doesn't work, you roll it out to a further month, and you pay more money essentially, or take on more risk on top of what generally you've already lost in the position, in order to try to buy the time to get it to work. That works for a while, and in a gyrating market, when it is kind of choppy, it's very forgiving and it lets that style work. However, in changing market conditions, especially in long trending markets, like we've had right now with the S&P 500 leaping some 250 points or more in just a matter of about 7 weeks, that type of a move really catches a lot of people that are trying to trade this style. Overall, what happens is that they start losing money as the market momentum picks up, and then all of a sudden they don't really know how to handle the position. They end up with a lot of positions that have losses in them. They haven't made any adjustments at all in the positions because that basically is what they're taught. Do their risk management before adding the position and just essentially leave it. And then you make a choice later whether to close it or roll it. And so what happens is that most are exasperated by the time they're writing me emails about this, disillusioned about the style, and often many are in pain about it because they've tried other things before. They had a sense this would work. They think option decay means it's an edge in some way because the options are they do expire. And what happens plainly is that they don't understand the trappings of option metrics of that style, and are very misinformed, and they misunderstand the edge in option trading. Truth is that if there's an edge in option trading, it's from discovering mispricing that's in options or in the implied volatility in options. It isn't necessarily an edge just because you sell something that is expiring over time. Actually, the pricing of the options do price in that time period. So there really is no edge to just be short options. And I actually could take this discussion so much further in so many different ways that it would be a lot more than one video that we're doing right here in option rolling. The big problem, I want to get back to this option rolling discussion, is that the mindset on rolling it compounds all of the problems. In other words, this whole mindset that they have that when it goes wrong, you just roll it and buy time. They're taught that there will be some reversion to the mean. In other words, the market will eventually change direction at some point, and then they will be right. What they do is disregard the forces in the market that made them wrong over the past period of time. It might be for months of time that there is some momentum, and these positions keep being wrong, and you roll them, and even the rolled positions tend to be wrong again. They tend to roll many times. It's this whole mentality of roll it till you get it right. And what happens is that, well, they never recover. They give up, or when they finally do recover something, it's a small amount of the overall money that's been lost in the positions. For example, if you have a position on that, let's say, has a 2-to-1 risk reward, let's say you're short an out of the money vertical spread, and you know that you have about a 66% probability of profitability on the spread. When this, if you get a max winner on the trade, well, you're going to make, X amount of money. And if you get a max loser on the trade, you're going to lose 2X on that. So in other words, you lose twice as much as you make. So where's the edge in that, right? Well, the edge may come from being good at trading it or taking the position off at an earlier time, but then of course you're trading and it's not mechanical anymore. So there's some conflict in the whole style in there. So what I want to really look at here is, when a trader looks at doing these trades, what is it that they really want? Well, when you listen to these, you're going to know that there's something in there that isn't really right in the mindset. It's they want to avoid locking in a loss, of course. So what they do is they roll a position that is wrong into another position that you have no sense of whether it's going to be right or wrong, and in fact it's most of the time against the momentum of the market, so there's maybe a good chance you'll still be wrong in that. There will be what they want is a chance to get their money back, so they're motivated by money and not motivated by the other important analytical aspects of putting on the position. They're in this mindset of the market can't do this any longer, can it? You don't know how many times I get an email with that question. Can the market keep going up this way? I mean, it seems like those come all of the time. And at that point, they may even be in revenge trading where it's the war of the market move against me, and it ends up to be a very, very difficult time right there, because then trading is so emotional in that aspect. So there's so much of this that feeds into some unhealthy approach to trading when you look at rolling positions. So I think I covered that pretty well as to the mindset and the way people are taught about rolling positions in option positions is really what we're talking about here, though it shows up in some other aspects of trading also, and we can talk about that in separate videos or if you send me emails, but mainly we're talking about rolling option positions here, and that mindset is really important to change. The mindset of that I'm losing money, now I need to buy more time to try to get my money back. I mean, that's basically the core of it. So what then makes, a healthy mindset? What are the rules to do things a little differently? Well, I have 3 rules actually that I think are very important. This is a whole thing of unlearning, and when I work with a lot of traders who are trading options and have been through this, where they've learned from other sources, and some of you know where I, what my history is and how some of this has been taught in other ways. I don't really want to name names or point fingers. I just want to really focus on how to do this better. It's helping people to unlearn some of the things that they've learned before from these other sources or teachers or experts in options. So I'm going to give you 3 rules I think that it is important to apply to your option rolling and your option positions. And if these don't apply, well, then you have to really think about this again. So here are my 3 important rules. Rolling option trades, the healthy mindset. 3 important rules. Number 1, never roll an option trade because it lost money. So that is, so much of what people do, as we just discussed. And it might actually be better to roll positions that have winning positions on, because what that means is that you've taken in a winner, right? Because you've made 50% or more of what could make, but the momentum in that trade is probably still alive, so you might want to find something in the same direction with more duration to take in more premium. So never roll an option trade because it lost money. That should never be the reason. Number 2, never roll forward the dollars lost. So in other words, if you've lost money on some option strategy, and you've lost a certain amount of money, the new position should not be contaminated by that money, because what you'll essentially do then is hope to make the amount of money back that you lost based on the new position and have some sense of getting even. What if you have 2 losing positions in a row? Then the second time you roll, that second position has to make back what the first 2 lost. You end up chasing dollars versus actually analyzing the new trade as if it was a total new trade. So that brings us to number 3. Always treat a rolled trade as a new trade. In other words, it must have strategic and analytical justification all on its own. The option strategy has to make economic sense, and you have to have an analytical overlay that is justified for the trade. In other words, you don't just put on a trade because you're selling premium. What you want to do is have a strategic advantage in the trade and an analytical advantage based on your entry. Now that's really what we do in rankings and setups, is that we do our best to find improved entry locations so that we can get a little edge, raise the odds of being profitable on that position, or raise the odds that our location will have less of a risk of a psychological hit because we've put it on better. So in other words, it must have its own win-loss parameters, having no relation at all to any other trades. If you cannot justify a rolled trade to stand up completely on its own as a new trade, well, that trade should never be put on. So those are my 3 rules about rolling trades, and what I believe puts someone into a healthy mindset about positions that have not gone right in options, and about assessing the option of, or the choice of, rolling into a new option position, which essentially taking off the old one. Remember, taking off the old position and then putting on a new position. Old position, new position. That's really so important to this discussion, is having that healthy mindset. That is style, strategy, and plan. And I hope you've found a lot of value in that. Send me an email and let me know. I'll see you in the next segment.